Welcome to Honest Money, your best guide to financial freedom. I'm Warren Ingram, the author of a few best-selling books, and I'm also an award-winning financial planner, and I've helped thousands of people on their journey to financial freedom. I'm not here to tell you what to do, but I am here to share my experience and the best ideas that I've learned, and I hope these ideas help you on your journey to financial freedom.
Hi Warren, my question to you is, how will you calculate what the real return is on your investment if you look at a fact sheet of an ETF? For instance, if the fact sheet shows your return for the last year was 7%, but inflation was 4%, does it mean your real return was only 3%? And what about the 10-year growth average of like a 10% return? Should you average inflation over 10 years and also deduct it from your return? And how much does it really matter?
Thanks very much for your question. It's actually something we haven't really spoken a lot about on Honest Money is inflation and the impact of inflation on your investments over long periods of time. So just to answer your question as to how you calculate a real return on investments, your example of where your investment has delivered a growth rate of 7% over the last year and inflation has been 4% over the last year, you're correct. Then your real return would be the difference. In other words, 3%. So what that means is when we talk about a real return, we're saying how much has your money grown in actual buying power? How much has it grown faster than inflation over a period of time? And definitely it is a very big factor. It's something we should talk about a lot because when you have investments that are growing slower than inflation, so let's say, for example, inflation's growing at 5% a year and your investment is only growing at 2% a year, you might feel like you're not losing any money. You know, your investment has still gone up over a 12-month period, but actually the buying power of your money has gone down. And that's really dangerous for people who are retired, for example, and are living off their capital. So if your goal is to get to financial freedom and to get to the point where you can, generate an income from your capital that will cover your cost of living, then you need to know that your capital is growing faster than the cost of living is going up. And that's quite a difficult thing to do. So I think it is a huge issue, and it's something that doesn't get a lot of attention because we don't get major news headlines or media headlines when inflation goes to 4% and your investments are only growing at 3%. We get major headlines when investments have dropped by 30% or jumped by 30%. But unfortunately, inflation is like a slow poison. It just gradually eats away at the buying power of money. So I think it is a big issue, and it really does matter. But I think it's important to know that there are a lot of times where investments won't do better than inflation over a 1 or a 2 or a 3 year period. And that's okay. It's not a problem for that to happen. What is really important is that your investments grow faster than inflation over 5, 10, and 15 years. And the assets that do the best against inflation over long periods of time will be things like shares, property companies, and sometimes certain kinds of government bonds. The assets that do worst against inflation will always be cash, because cash just has a history of tracking inflation almost exactly, and then you pay tax on the interest that you earn from your cash. So yes, I think it's a great thing to focus on. Make sure that you do know that your investments are performing better than inflation over long periods of time, but don't panic when over a 1 or 2 year period they underperform inflation. And I think make sure that the mix of your assets is right. That's really the way to make sure that you beat inflation. In other words, make sure that you've got more shares and bonds and property than cash in your portfolio. And you should be, if you stay patient and you stay invested, you should be confident that your investments will beat inflation over long periods of time. In South Africa, you can expect to get about 3 to 5% a year above inflation from things like shares and property. And as I say, almost nothing above inflation from cash. So realistically, that's what you should aim for: 5% a year above inflation when you've got a portfolio of shares or an exchange traded fund or a unit trust that invests in shares. Hope that helps, and thank you for the question.
Warren, it's Jake from Cape Town. Just a quick question. My in-laws have about 500,000 Rand that's in their bank account, and they just want to invest it somewhere. They don't need access to the next 2 years, but I want them to get some growth. Maybe after 2 years, I want to access some of it. What's the best vehicle that you'll use for this money? Where should they put that? And yes, I'm listening at your podcasts for the last 5 years, so probably I should know the answer, but unfortunately I don't. So we'll really appreciate your help so I can guide them to do the right thing. Thanks so much. Bye-bye.
Thanks, Jake. I think that's actually a really relevant question at the moment. A lot of people with capital to invest are looking at the returns of the JSE, looking at how little interest they're getting on their cash, and wondering what the way is forward with their money. So I think for your indoors, I'm just going to make an assumption that they're in their kind of late 50s or older. And if that's the case, then when you're investing money for an indefinite period of time, in other words, when you don't know whether you're going to need some or all of the money from 2, 3, 4, 5 years onwards, then you need to be very careful of taking too much risk with the money. And in my mind, that means taking all the money and putting it in the stock market, because what you might find is that in 2 years' time, when they need some of the money, the stock market has fallen, and so that they need money and they're selling assets at a time where those assets have lost value. And that's always a real problem for people that need to access their money at a particular point. So I think you've got to be careful that you don't have 100% of the money in shares. At the same time, to keep all the money in cash when you know that they probably won't need all the money in 2 years' time is also not right, because I think you're going to get probably 3 or 4% on interest in a year on cash, and we know that inflation is a bit roundabout there. So I think that's not a great idea either. So most likely I would select a balanced type unit trust for them, and make sure that they've got at least about half of the money that's in that unit trust is invested in shares, and then the balance can be split between cash, property companies, and bonds. Over time, that should do quite well. That should give you sort of 3 to 5% above inflation in the long term, but in the short term, it can be very volatile. And what we're hoping there is that the diversification of the investment makes sense, that it protects them when markets are falling if they need money. And if that is the case, I would definitely advise them not to take all the money in one shot. So in 2 years' time, if they need some money, rather tell them to draw the money, in a month, or every month, or every quarter, or every 6 months, so that you do the opposite of phasing an investment in. You phase the investment out here, so that you can spread out the effects of any big volatility in stock markets. And I probably would add a bit of an offshore allocation to that as well. So most likely I would choose 2 unit trusts, one that's got around about half to 75% in a balanced fund, and then the other bit, the other half or other quarter, depending on their risk, in a rand-based global fund, global feeder fund. And you can choose a really good, strong, diversified index tracking unit trust, for example. You don't need to go into an active fund, and I might do the same for the offshore as well. Just a strong, a feeder fund that invests in global markets as well. That gives you lots of diversification, a good rand hedge if the rand does weaken in the future, but also helps allocate money to markets that we can't invest in South Africa. Thanks for the question. I hope that helps.
Hi, I have no short-term debt and only have a home mortgage bond to pay. I have very little saved on my emergency fund. Is it better I first save more on my emergency fund, or should I first max my tax-free savings account?
Gee, that's a brilliant question. I think, if you're looking at someone who's got a home loan and no other debt, and then, trying to decide whether to save in a tax-free savings or in your emergency fund, there are a few different kinds of levers that you can pull with your financial planning here that are important to understand. And then you need to make the right decision that suits you. So the first thing with your home loan, if you're a very disciplined saver and a very disciplined person with money just in general, then I find that paying extra money into a home loan is a great way to actually build up an emergency fund. So it's very important before you do that to know that your home loan is an access fund. In other words, an access bond. In other words, that you can take money in and pay extra money into the bond and draw it out if you need to. And it's worth testing that before you make that your place for your emergency fund. But maybe just take 500 Rand extra, put it into the bond, wait a few days, and see if you can draw that 500 Rand out. If you can draw it out quickly and without any penalties or any other nonsense, then I think that's the best place possible for someone who needs an emergency fund, who has a home loan. Because over time, the interest that you pay on a home loan is always much higher than the interest that you will earn on cash in your in a money market account or something like that. So for me, when I have a bond, I always make sure that I pay a lot more money into the bond than I need to, and I always make sure it's an access bond, and then that's what I use for my emergency fund. And obviously, I guess it goes without saying, but it's important just to remind everybody, if you have a home loan and you have no other debt, it doesn't mean that you should take 20 years to pay off your home loan. You should always try and pay a bit of extra money into that home loan every month and try and pay it off as fast as possible. At the point of financial freedom, we need to be debt-free. If we look at the other parts of your questions there, so do you then build up your emergency fund first, or do you build up your tax-free? I always think you want to make sure that you've covered your emergency fund as fast as possible. The reason for that is that, if something happens, let's say, we've learned with COVID, you could lose your job tomorrow and you don't have an emergency fund, then you might need to sell your tax-free savings account, if that's what you've been doing with the extra money, at the worst possible time where markets are falling, and then you're selling your tax-free savings, which means you can't take the money out and put it back in again. So you've also lost that lifetime access to the money that you draw from your tax-free. So to me, before I start investing, I always want to make sure that I've got my emergency fund covered. And just as a reminder for everybody, emergency fund should be about 3 to 6 months worth of your expenses. And if it's not going to be saved in your access bond, if you don't have such a thing, then put it in a money market account, something that you can access very quickly, very easily, and without any fees or penalties. And I think once you've got your emergency fund saved, then it definitely makes all the sense in the world to start, going into your adding money into your tax-free savings and doing that as fast as you possibly can. Remember that we can't do more than 36,000 Rand per person per year, or 3,000 Rand a month if you want to do a debit order. So, try and get to that number as fast as possible as well. But in the meantime, well done on being debt-free, and definitely try and store a bit of extra money in the home loan, and then get going on the tax-free. All the best with that plan, and thanks very much for your question. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.